Okay, so we are ready for the pitch competition now. I want Essie, who's the founder of Turtle, to please come and tell us a little bit more about Turtle, maybe first.
Well, thank you for having me. Pleasure to be here, everyone. Thanks for attending. So my name is Essie Lajavadi. I'm the CEO and founder of Turtle Club. I'll start with a brief introduction about myself and how that led into Turtle and what we're doing. So I've been in crypto since 2013 as a kind of a passive hodler, been working the space professionally since 2017, and really been interested in the art of trying to deploy liquidity very efficiently in the space, trying to move liquidity in a way where I subject myself as well as my LPs liquidity the least friction possible so that we can route the liquidity in the space where it can be used most productively. Whether that be through utilizing the liquidity, monetizing it, or ensuring that we're safeguarding the liquidity of our LPs in the most responsible manner possible. So I came up with this idea of like a liquidity protocol, non-custodial liquidity protocol back in 2021 when I was managing part of the treasury of one of the largest GPU miners in the space. And back then, I kept coming across new protocols that were looking or asking us to help them, bootstrap or anchor their protocol. And one of the things I noticed is that by committing or making larger liquidity commitments, one could negotiate additional benefits or upside on behalf of my clients or LPs in our liquidity syndicate. So I realized that if I wanted to compete or, at the top of the liquidity space, I would just get more competitive and that I would need to be able to tap into a larger liquidity base of LPs to be able to offer my LPs some competitive sort of emissions or incentives on the upside, but also to cover the costs of due diligence on a lot of these opportunities, given that many protocols subject their LPs knowingly or unknowingly to many different types of risk across the stack. And that's when the idea of Turtle was born. So in March of last year, I decided to kind of, quit my job and pursue Turtle full time. And the idea of this non-custodial liquidity protocol is that we want to be able to route the liquidity of our LPs into the protocols that can best utilize, monetize, and safeguard their liquidity in a trust minimized manner, on a non-custodial manner, so the liquidity always stays in the custody or wallet of our users. And if we were to be, hacked, or, if I were to turn evil tomorrow, that none of the liquidity of our users will ever be at risk. So yeah, since then, we've been able to build up a really big liquidity base of liquid funds, miners, family offices, DAO treasuries, high net worth individuals, and a long tail of smaller, medium-sized, and retail LPs. And we've been working with hundreds of protocols all across the Web3 stack, from different chains to dApps, asset issuers, infrastructure protocols since then. So yeah, it's great to be here, and looking forward to checking out some TVL deals today.
Thank you, Essie. So the way this is going to work is we have founders who are going to come and pitch their products here, and then we'll let our judges ask them questions. At the end, we're going to be announcing who's going to be our star team and who probably would have a potential investment from our judges or even being chosen to be LP'd. I'll let my judges also please introduce themselves. Alex, if you can please pick up the mic and very briefly introduce yourself, and then we can pass it along.
Hi, everybody. I'm Alex. I'm the founding general partner at Verda Ventures. We invest in stablecoin infrastructure, also an active angel investor for the past decade in Web3.
Hi, everyone. My name is Rico. I'm with Cyberfund. We're the founder-led fund by the founders of Lido and P2P staking.
Hello, my name is Deke Wilkins. I am with Mbushi Capital, which is an OG VC founded in 2015 with Vitalik and some of his partners from Asia.
Hey, Roman. My name is Rob Kajalot. I'm founding partner at BeatScale Capital, prop venture fund operating from 2017. Thank you very much.
Hey there, I'm Armin from Gnosis VC, investment partner there, and CTO at Cerberus. Yeah.
Hi, I'm Nate, founder of Token Dynamics. We're a protocol design and economic security firm focused on token value accrual and censorship-resistant protocols.
No. I'm the last one. Hi, everyone. I'm Dima. I'm CTO at Pinksbytes. We're in Lido, Aave, Curve, 1inch, and other folks.
Well, thank you so much to all our judges. I'm really excited for this, for everybody sitting here and also everybody who's going to be watching us later on YouTube or any other platform. First up, we have Varoun from ViFi Labs who's going to be pitching his product. Varoun, yes.
Hola, Buenos Aires. Okay, so today we're going to be solving on-chain FX. So right now in the FX landscape, there's basically off-chain and on-chain. Off-chain is swapping stablecoins for local currency. There's centralized exchanges, there's peer-to-peer like Binance P2P, there's a lot of OTC desk. And then on-chain, there's like Aerodrome, CurveFX, and Uniswap, V2 and V3. Why on-chain? Why not stick to off-chain? Because you want guarantees on market making liquidity, you want settlement guarantees, you don't want counterparty risk, and you want to be able to extend into things like DeFi lending. So why is it so hard? This is an excerpt from the IMF basically saying that central banks overvalue their price, and thus it's very difficult to market make. This is from the World Bank showing what official rates look like, and then what the secondary parallel market trades, and there's a huge premium, thus making it very difficult to market make. So you guys have been here in Argentina and you have been spending money at restaurants, and you would, if you guys notice, there's like the official rate, there's like the blue dollar rate, there's fintech rates that operate on P2P, and effectively you have to figure out which fintech app you use because you might be getting 5 to 10% discount based on what you use. Now, ideally, if we want to be able to do cross-border payments with stablecoins and US stablecoins and local stablecoins, someone should be able to go from US to USDC with like Circle Mint, do a swap on-chain from USDC to IDRX, for example, 24/7 instant settlement. Then through a PSP via bank transfer, you could get that IDRX back to IDR, and that's a whole import-export flow. But what's happening is that whole FX settlement, people get screwed in the back end. So this slide here, someone sending 5 US, and like the comment from the tweet is that this guy got ripped off on the FX. So let's see how we could solve that. So this is what like a DEX swap could look like, USDT to USDC. But what if you wanted to swap to local stablecoins? So in this example here, you have this hypothetical local stablecoin for the Trinidad and Tobago dollar. I'm from Trinidad and Tobago. And even though the central bank says it's worth 6.8 to 1, it's currently traded in secondary markets at 8 to 1. So we want to swap 80,000. And let's take an example of Uniswap versus what ViFi can do. With 200,000 KTVL, you could have $80,000 swapped and you would get 9,000 out, so like about 10% slippage, and the price would move to 8.8. Whereas with ViFi, you could swap that 80,000, get about 1% slippage, and there's a slow FX movement. Now, the question is, how do we accomplish this? So traditionally, in Uniswap, there's 2 pools. There's USDC, TTDC here, being the secondary emerging market currency. And what ViFi is doing is routing the liquidity through 3 layers. There's one virtual fiat environment, which is our mechanism. And then there's 2 curve stable swaps, which we call a stable swap sandwich. So USDC gets you to USDV, which is our native unit of account. Then that USDV is swapped for TTDV here, which is synthetic. And then that synthetic TTDV is swapped for TTDC. Now, the reality here is that instead of the 200,000 being pooled in this Uniswap, you could have 25,000 at the edges and 150 in the middle, and you still get that 1% slippage. Now, what's this virtual fiat environment? What's this mechanism, this black box? So what we do is we split a USDV into two tokens, a fiat token and a redemption token. There's a redemption token, fiat token pool, and then you sell your redemption token for fiat tokens, and then you get the premium. And then that is swapped for real world assets. So let's take an example. We're in Argentina. What if you could swap one USDV and you have an oracle? This oracle is 24, it takes about one 24-hour period before it updates. The official rate doesn't change often. So you could get 1350 minted and one redemption token. And let's say right now the spot rate is one redemption token is with 100 fiat tokens. That means that you could get 1450 fiat tokens out, and then you have 1450 synthetic Argentinian pesos, which could be swapped for real world asset Argentinian pesos. And what does this look like endgame? This is what it looks like to onboard all the global south currencies. So you could have Colombia, Brazil, Kenya, Nigeria, Indonesia, and any currency. And the idea here is someone from Colombia could swap, and without having to go out into USDC, go into Indonesian rupiah. Someone from USDC in the States could import from Nigeria. And now you could bring all the major market currencies on-chain. There is a virtual strategy vault that allows you to stake USDV, and that stake USDV deploys the liquidity across all virtual fiat environments. It's all synthetic, so at any point, let's say the currency collapses or is insolvent, you could terminate the virtual fiat environment, and the LP is fully reclaimed in USDV. And SUSDV is a combination of the risk-free rate plus FX fees. So you're not only, you don't have to like compete, the FX fees doesn't have to compete with whatever the risk-free rate is. You get whatever the risk-free rate is plus on-chain FX on the global economy. So this is what a potential endgame looks like, where you have this importer send it in USDC, you get IDRX, that's straight to their bank account, and everything settles on-chain, no settlement problems, no...
Thank you, Varoun. I'll give it up to our judges now if they have any questions.
How do you bootstrap the liquidity in those FX pools?
Yeah, so do we get slides or just... Okay, cool. Yeah, so if you want to bootstrap liquidity in these pools, of course you would have to do, let's say, incentives with the ViFi token. There's a ViFi token that manages votes that allocates liquidity across all the USDV pools. So basically, you use the ViFi token as a bootstrapping mechanism to get people to put liquidity in it originally.
And do you do this across all those pools, or is your go-to-market like focused on one specific currency?
It will be across all currencies because you vote escrow the ViFi tokens, and then it deploys votes across the liquidity pools where most volumes are trading. Kind of like Aerodrome.
Why use Uniswap v2 as the point of comparison? I mean, XY equals K automated market makers weren't really meant for stablecoins. You could use concentrated liquidity in V3 and with enough liquidity get similar slippage.
Sure. Great question. I love that question. So the reason why we usually show Uniswap v2 is because Uniswap v2 gives price discovery. And these markets require price discovery because the supply and demand for US changes day to day. So what most markets happen when they do concentrated liquidity, and you could look at CNGN with USDC, is that the market maker is supplying liquidity, their concentration band. The liquidity moves out of that, and then everybody's getting insane slippage because you require a professional market maker to reallocate with the tick range for the concentrated liquidity. So while you get optimal slippage with V3, it requires a professional market maker to rebalance the liquidity, whereas this requires no rebalancing. You get price discovery only on the parallel premium.
But the price discrepancies are arbitrage, though, in real time. You don't need a professional market maker to manage V3 liquidity, because if there is a triangulatable arbitrage opportunity, it would be exploited by the market makers.
The reason why so you're correct that there is an arbitrage. That's not incorrect. The reason why it's difficult is that arbitrage happens over days. So there's no T+0. You have to actually go maneuver through TradFi systems, get through capital controls, and then rebalance that. So because of that time discrepancy, there's like an option pricing on how long it takes to settle. So the redemption token effectively prices the time difference to actually settle that arbitrage.
Got it.
Am I correctly understood that USDV is your stablecoin, right?
What's that?
USDV is your stablecoin.
Yeah.
How are you going to issue it?
It would be like M0 wrapped, so it's all real world assets backed by short-term treasury bonds.
Okay, so just as a recap, our judges just have 3 minutes to ask the questions, or yes, just question the founder, and the founder has only 6 minutes. After that, the mic goes out. So yeah, this is going to be it. Thank you so much, Varoun. Everyone, please give it up for ViFi Labs. Next up is Alan from Covenant. Again, as a reminder, when you see the timer in front, come close to the end, please wrap it up. We have 6 minutes for the founders again, and 3 minutes for our judges.
Do we start? Hi, everybody. I'm Alan, founder of Covenant, DeFi's liquid credit layer. And when we think about credit, and it's a very simplified view, top down, you can think of liquidity first credit and collateral first credit. Liquidity first is you actually have to deposit USDC, USDT, maybe use the utilization of that pool to determine your yields and whatnot. But then that's used to either give out loans, margin loans, or if you go to TradFi, use it for other types of credit. Collateral first is where you don't have to deposit USDC, USDT. You literally are creating a fully collateralized synthetic stablecoin backed by that collateral that gives you yield. Maker, Sky would be one of the first versions of that, where you're issuing a stablecoin. Pendle is doing that. Their PT token is a yield token, fully collateralized. FX protocol is another example. It's not exactly a yield token, but it's a senior tranche that has lower volatility. And this is actually how banks work. Banks don't work by taking deposit and lending it out. They actually work by minting money through the loans that they create. So it's collateral first. We are basically creating a system that is permissionless, structured product that go collateral first. Effectively, any collateral can be used to mint leverage tokens and yield tokens, fully backed, and where the liquidity itself comes from the collateral, and so before I move on, an example of this is a collateral could be volatile collateral like ETH, or could be sort of like more stable collaterals like SUSD, where you actually have a collateral with yield. So the leverage token effectively is giving you exposure to the base asset, but with leverage, and they pay funding to the yield coin or token. And the yield coin or token is effectively the senior tranche, fully backed. In our case, it's a zero coupon bond, very similar to Pendle, very similar to Element Phi and whatnot, but perpetual. So there's no sort of maturity. You don't have to sort of continuously create new markets. It's once the market is created, it goes on forever. But it has this dynamic that the price of that coin dictates the interest rate of that coin. And obviously it's earning funding from the leverage coins in a very capital efficient manner. Like if the leverage coins are paying $10, the yield coins are getting $10. And for this, we basically using, and I think you were mentioning concentrated liquidity. We are using sort of like a similar concentrated liquidity as Uniswap v3, but it's instead of a concave curve, it's a convex curve. Instead of we put two existing tokens as liquidity and you can then swap them, we effectively just put the collateral, the value of the collateral as your liquidity, and then you can swap the value of existing yield coins for the value of leverage coins. And what you get is a very simple system. You can launch these markets, and this will be sort of permissionless. You need an external oracle, But effectively, the more people demand leverage coins, the ratio of leverage versus yield coins goes changing. And as in a Uniswap market, the price of that market goes changing. And so what happens is the price of debt goes going up as LTV goes up, and the APY of that debt goes going down. So you can think of it as an Aave, it's an utilization of yield, but there's no price difference. In this is a market where there is price difference. It's like sort of a short-term bond sort of credit, where again, you're not using USDC, USDT, you're just basically using the collateral itself as liquidity. We are about to go live on Monad next week. We've been on testnet for a couple of weeks. We just finished our audits, and here's an example of 5 different markets. These are very Monad specific. The first 3 are LSD tokens that have yield, and the bonds, if you will, the yield is denominated, it's a yield coin is denominated in MON itself. So those markets are closer to Pendle, if you will, right? Like the leverage coin is an insurance layer, tokenized insurance layer, you could call it, or leveraged points, whatnot. The yield coin is basically the sort of like a senior tranche where you can go in and effectively you're pricing the yield of the overall underlying collateral. And you also have the ability to lock in rate given the duration of these bonds. Or you can go to more volatile collateral, like in this case BTC, and here it's a bit of a lower leverage target, but same thing. You're basically creating effectively stable coins with yield backed by different collaterals. The interface itself then, from the perspective of the user, you're just swapping. I want to swap collateral for a leveraged exposure, or I want to swap collateral for a stable coin backed by that initial collateral that has yield, and the supply demand dictates the yield. So you can just be passive, get yield, you can be passive, get leverage, or you can be a trader and go back and forth and see how that takes you. So basically summary, Covenant powers liquid leverage and yield markets backed by any collateral assets, and that's my contact. Thanks.
Super on time, awesome. Judges, this is your cue to ask questions.
Thank you for the speech. I wanted to ask you how PEG is achieved, and have you run any stress tests on this?
Sorry, the first part of the question is how?
PEG is achieved.
How PEG?
Yes.
There is no PEG. Okay. The price goes fluctuating around, so effectively you have an external oracle. If it's a volatile collateral, it gets closer to a perpetual DEX, a perp. So we're using PIF pull values, for example, the BTC one. And what happens is, if the debt is at par, like zero interest, then from a market perspective, you could swap the debt for the collateral at the price of the external oracle. But then depending on supply and demand, you basically go up and down on that price. So there's no peg, but you go up and down on that price as dictated by this market itself. So it's basically a market around the oracle price, if you will.
Good, thank you.
You're welcome.
Any other questions?
Two-part question. Yeah. What made you choose to deploy and launch on Monad first? And could you maybe describe the risk profile one is exposed to?
The second one, sorry?
The risk profile one takes in account when you're exposed to your products.
Okay, so first one, Monad, is more, I know the ecosystem, and is a bit more tactical. When launching as a new protocol, you want to sort of like have a bit of the marketing spend of the underlying chain, if you will. But we are not, we're gonna then expand to other chains. We have a bit of this can work for multiple markets, more volatile or less volatile collaterals, but we have a hypothesis that actually is less volatile collaterals that will ultimately be the product market fit. So getting other yield-bearing but highly risk tokenized strategies as collateral, and then basically providing an insurance layer and a senior tranche that you can lock in rates. In terms of how do I think about risk, I don't. These are just permissionless markets. Anybody can create them. it's tranched. Anybody can tranche them with a target, and I can talk a little bit about that. But effectively, supply and demand of like, do I want leverage or do I want the debt, dictates the interest rate, and that's going to effectively coalesce around an LTV and a yield for that, given that collateral.
15 seconds left. Any other question?
How do you facilitate liquidations?
I'm sorry?
How would you facilitate liquidations of the leverage tokens?
There are no liquidations. It's basically equity and debt. If the value of the collateral is going down, the value of the equity is going down. And so effectively there's an incentive at that point, given price.
So you can redeem the underlying position. Thank you so much.
Yes. Everybody, please give it up for Alan and Covenant. Next up, we have Dio from Yieldnest. Once again, the judges also only have 3 minutes, so we'll keep the questions brief, and also I request the founders to be brief in the answers. Go on.
Thank you, and hello, Argentina. Amazing to be here, and thank you for giving me the opportunity to pitch for everybody here. I'm going to present today Stack, a product from Yieldnest, merging real-world stability with DeFi efficiency. So first, before I dive into Stack, a little bit about Yieldnest. We've been live for over a year now. We have around more than $60 million in TVL, and we built our DeFi structured product platform that brings pristine collateral on-chain, and we always try to design our derivative products in one token and make all our accounting on-chain. We plug into DeFi yield, RWA yield, restaking yield, and we design our vaults so they can't be evil. It's safe transaction guard, fully on-chain accounting, and all transparent flows. But there's a bit of a problem. Recently, we have launched our new RWA asset, Wine RWAX. It has a 1-year coupon. So real-world assets are great because they give us finally the stable and reliable yields that DeFi needs to actually build a thriving and more stable industry. Real-world assets are backed by tangible assets. They have scalable yield sources, so we can actually inject much more yield, much more capital into it. Disadvantages, these real-world assets are locked up mostly for a year. They're centralized and off-chain, and there's fewer exit options. Then on the decentralized finance side, we have also our Wine USDX derivative, give you low risk DeFi, balancing over different lending positions in a way that it's more safe than if you would go into stream finance or some other non-safe DeFi vaults. There's in DeFi we have higher yields. There's decentralized on-chain. Mostly there's no lockups. It's highly liquid, and there's many exit options and composability. The disadvantages are their yields are volatile, unclear yield sources, and it's less scalable. So that's why we introduced stack vaults, where we merge the best of DeFi and RWAs into a single token, where we have lowest DeFi and lowest RWA yields, auto-compounding all into one token. And we can achieve around 10 to 20% APY with this, combining Wine RWAX and Wine USDX. And a little bit more about Wine RWAX. What is it? Well, we basically bring a private credit on chain. It's backed by Australian real estate. I have a background in RWAs, even before I started Yieldnest. I did some work with MakerDAO. I did some work with other RWA projects. And afterwards, I started Yieldnest, and I have connections in Australia, work with a developer that basically has a bunch of real estate, and he wants to borrow against his completed projects, and we bring that on chain. Well, the problem is it's locked up for a year. So the asset itself is locked up for a year, so the market doesn't really like that, and we need to make that a little bit more reflexive. And that's why I thought, let's wrap this in the stack vault, which is basically here the user comes in with USDC. We wrap that into the stack vault. This is an ERC 4626 compliant vault where the USDC gets injected. And then we have different instruments in DeFi that we can use because we kind of keep the balance 50-50. For example, we can put it in a liquidity pool, we can put it in a Pendle or Spectra markets, and we can kind of play around with that in these markets so that we can create more volatility or reflexivity for these assets, then we auto-compound these yields into number go up. So then the stack vault token goes up. If a user wants to redeem, he can always redeem, but there's going to be a little bit of a haircut into that, right? And he can always redeem in the USDX asset. Then when RWAs matures 1 year later, the whole system kind of rebalances itself for the people that were like, okay, I can stay for a year. They get they can just exit in that liquidity event, and the people that decide to exit a bit earlier for whatever reason, they can do so. But there will be a slippage, and all that slippage will flow back into the vault itself, creating this reflexivity. A little bit about the risk and risk assumption mitigations. Yeah, the RWAs is secured asset, independently valued. The duration, we manage the duration risk by basically starting off 50-50, and then it imbalances over time. The more surcharge there comes, and the slippage flows back into the vault. The smart contracts, it's built on the Max Vault architecture. That's something we built in-house. It's a new vault architecture where we design. We took our learnings from kings in the DeFi space, like Kern and other vaults, and we designed it so that we have a little bit more flexibility. If there's ever a DPEG, the RWAs token is then available for this case, the issuer in Australia, where they can repay their debt and rebalance the pool. And even if they take a long time for that, or it takes them some time to get the capital ready, it will eventually, if it matures, it will always be better for the people that stay into the vaults. Yeah, that was it. We're looking for partners to bootstrap the liquidity for the stack vaults, and I want to make stack the standard for RWA and DeFi yield in DeFi. Thank you.
Fantastic. Judges?
You mentioned a couple of times that there's a slippage or a haircut on early redemptions. Can you give more specific figures on how punitive that is?
Yes. Can I go back with slides, or?
Yeah, can we get the slides back again?
And it's basically what we're doing. And so those yield curves are very complex to create. So you could say if it's in a liquidity pool, when somebody withdraws, there is a yield curve with a surcharge. If let's say there's $10 million, if a person comes in and just redeems $100, the slippage is going to be very low. When everything comes at once, the slippage increases as a surcharge. And then if there's if the issuer doesn't rebalance it, it could be indeed that the slippage or the redemption fee goes up to a high percentage. The people that are still wanting to take that haircut, they can if they want to. The people that want to stay, they can stay into the vault, right? So it kind of creates this mechanism of if people panic in the vault, the people that stay calm will make more money, and the people that don't stay calm and don't maybe not trust the RWA collateral, they take the haircut. There's also a way to do a balanced withdrawal. So let's say the balance sheet start off 50-50, 50% via USDX, 50% via RWAs. Then if there is an imbalance, let's say it goes to 60 or 70%, you could say, I want to do a balanced withdrawal. Then you get the RWA asset and the USD asset. And the RWA asset maturity will be redeemable for USDC.
If there's any feedback or any comments that I just want to make, we have 1 minute. You guys can still do that.
I have a question. Given that as part of the underlying design of the protocol, LPs need to make longer-term liquidity commitments, and given the very dynamic nature of DeFi and crypto, and kind of no one can kind of really know how the market's going to behave in over the medium to longer term.
Yes.
In my experience, LPs tend to discount the yield that they're earning, especially over longer term sort of maturity dates. How do you address kind of some of these friction points? Because by having these longer term maturity dates, from an LP's point of view, they demand higher APRs.
Yes.
So to make these longer term commitments, which in return will increase your
I see we
cost of
just
capital.
have 10 seconds.
Okay, well, so how do you make it, I guess, more attractive for LPs to come in and make these longer-term liquidity commits?
Yeah, so basically we start off with a liquidity incentive campaign in the beginning. So you kind of drip the yield up front or the incentives up front, you attract the liquidity. The people that stay, they can stay in the vault, and the people that withdraw, once you get the game theory going, the game theory will play out. And also 80%, a lot of users in DeFi are bots, so it kind of also plays into the...
Yeah, that time's out.
Thank you so much.
Can we please give it up for the Yieldnest team? We'll have Martin from USPD next. 6
minutes. Hello, everyone. My name is Martin, and I'm the founder of USPD. Over 300 billion are today in stablecoins, but the largest stablecoin is still based on the principle of Trust Me Pro with Tether. And the second largest one, these are the wrong slides. The second largest one, Circle's USDC, is also highly dependent on banks and traditional finance in order to work. Even the crypto native Ethena, USDE, has the problem that it is still centralized and custodial. And the supposedly decentralized MakerDAO's DAI has become a wrapper for USDC primarily, so 76% of the reserves backing DAI are backed by USDC. So stablecoins today are unfortunately still centralized, opaque, and highly dependent on banks to work. A decentralized economy cannot be built on a corrupted base layer, and that's why I'm building USPD, an on-chain proof of reserves stablecoin. USPD is backed by 100%, 125% to be precise, on-chain Ether reserves, and it can be minted by anyone simply by sending collateral into a smart contract. The smart contract keeps the collateral in the form of staked ETH, and of course it can also be redeemed from the smart contract again. This whole process is decentralized, permissionless, and transparent. However, USPD is a stablecoin, and the collateral is kept in a volatile form, in the form of staked ETH, so our ecosystem requires a second player. And that second players are decentralized stabilizers, which have one job, and this is to keep the dollar value of the collateral that's pegged on chain constant by opening up a perpetual short future. And stabilizers do this with their own money. So they pledge 25% extra collateral on chain, which they lock into the smart contract as a volatility buffer. And they use another 25% to build up a perpetual future short position and create a delta neutral position with that. So stabilizers deploy $50 out of their own pocket for every $100 that a user mints. And they are not doing this because they are a charity, but they are doing this because they make 25% APY from funding fees. This is how a delta neutral position works. Stabilizers simultaneously $125 long via the on-chain collateral and $125 short ETH via a perpetual future. If Ether goes up in price, that means that the on-chain collateral is worth more, and they can use the excess collateral to cover their short losses. If the price of Ether goes down, that means their short is in profit, and they can use the short profits to top the on-chain collateral back up to 125%. So no matter what the price of ETH does, there is always $125 backing $100 of USPD. ETH staking generates 3% yield, and this yield is passed on completely to the holders of USPD. Funding fees we calculate in our economic models with roughly 10% annually. They generate 10% APY for the stabilizers, but stabilizers can leverage their position up because they don't need $125 in order to hedge $125 worth of ETH. They only need $50. So calculated on the capital that they deploy, they actually generate not 10% annually, but they generate 25% annually. This is also our business model. So we will operate a stabilizer, one of many. And to break the economics down, for every $100 of USPD that are minted, the stabilizers deploy $50 out of their own pocket as extra collateral and absorb the volatility. And they generate around $12.5 with that in annual revenue. So calculated on the capital that they deploy, this is a 25% return. The upper issuance limit for USPD, since this is a decentralized stablecoin, increases only in lockstep with capital that stabilizers are willing to deploy. So you cannot mint USPD infinitely, but only if a stabilizer is willing to absorb the volatility of ETH for the USPD that you want to mint. So how does this scale? It will scale via staking, via on-chain staking. So there will be a staked version of USPD, and that staked version of USPD will generate the entire funding fees, so that the entire basis trade of around 10% APY for the stakers. And it will grow in DeFi via money markets there because it has a very attractive native yield. So you can think of staked USPD as tokenized funding fees at the end of the day. And USPD scales its stabilizer via staked USPD. So this is the way we scale our stabilizer. USPD is the Swiss bank account in cyberspace. It has transparent reserves in real time that anyone can audit. It is permissionless in its conversion to and from Ether at any time. So no middlemen, no custodians. It has 3% native yield via staked ETH. We use staked ETH as collateral and we pass on 100% of the yield to the holders of USPD. It cannot be frozen, censored, or seized. And this is very important, I think, because all the centralized stablecoin designs are freezable on an address level. And it has zero exposure to banks and TradFi. The team consists of myself. I have a background in math and quant finance, of Andreas, who was a managing director at a quantitative hedge fund and is a PhD in computer science, and of Thomas, who is a well-known smart contract designer and Solidity expert. We have raised a $1.5 million pre-seed led by Draper Associates. We are live in public beta at uspd.io. We're looking for LPs for staked USPD. We already have 350K committed and are about to launch staked USPD. And we're raising a $5 million series seed of priced equity. Thanks for your attention.
3 minutes, judges. You can see the timer in front of you. Go.
Really neat design. Curious what happens when you adjust the collateral ratio up or down. How does the APY change for the various user groups?
You mean the extra collateral destabilizer?
125% for depositors, yeah.
There is no plan to adjust it down anytime soon. Actually, we're at the moment operating with more than 25% extra collateral for our stabilizer at least, but other stabilizers are free to do whatever they want. But stabilizers run into risk of being liquidated as soon as their on-chain collateral drops below 25%. So there's plenty of time to liquidate a stabilizer.
I mean, I guess the problem is if ETH collapses very quickly, your collateral would still be inadequate, right? Like the MakerDAO issue when they had that one-day drop. What am I missing?
There is a mechanism to reduce the market capitalization of USPD if a stabilizer goes bad. So yes, you're right. If Ether drops quickly, in our case, it would be a more than a 20% drop before anyone can.
So if it dropped 50%, which I don't think is terribly impossible,
over
like a 1 or 2 day period.
Okay, that's perfectly fine, yeah. If it's not from one block to the other, it's perfectly fine, because there is a mechanism to liquidate a stabilizer that's gone bad. So the moment a stabilizer drops, over collateral on-chain drops below 25%, they are technically in liquidation. Liquidation means that let's say the stabilizer backed 1,000 USPD. That means that there is now a bounty for the next 1,000 USPD that are redeemed from the smart contract of 5%. So you can, via a flash loan, hypothetically, you just borrow ETH, you mint 1,000 USPD, you burn it with the smart contract, and you get $1,050 out. So the market capitalization at the end of the day is then reduced by the bad amount. And the stabilizer loses everything, so they lose their 25%. And out of their 25, the bounty is taken to pay out the arbitrageurs that reduce the market capitalization of USPD in that case.
Great presentation. You mentioned that when one mints your stablecoin, you need 2 different stakeholders to sort of partake, the LP and the stabilizer. What happens in an instance where the LPs won't want to redeem a large percentage of the stablecoin supply?
You mean the LPs, as in the users who mint USPD, if they want to redeem?
Correct. How would that affect the stabilizers?
They can redeem at any time. So if you hold USPD, you just invoke a smart contract call and you redeem, and you have reduced the market capitalization of USPD by what you have held before. If a stabilizer wants to redeem, they can only redeem if they simultaneously burn the amount that they have backed. So if I'm a stabilizer, I back 1,000 USPD in circulation, I cannot just walk out, but I can reduce the market capitalization by $1,000 and burn against my own stabilizer state.
Thank you.
Everybody, can you please cheer up Martin and the USPD team? Next up, we have Marko from Tapir Protocol.
Oh.
6 minutes, go.
Thank you. Hey everyone, I'm Marko, I'm the founder of Tapir Protocol, and yeah, it's a risk protection marketplace for high-yield DeFi products and stablecoins. Now, since 2020, the loss on from stablecoins and other pegged assets, depegging, is north of 1 billion. And it doesn't include UST, Luna coin, and this is basically the liquidation losses and other related losses to the depegs. So the problem is still quite big. We have seen recently, you know, depegs are not a problem until they are, as we have seen with XUSD. Now, the current opportunity and the future opportunity, what markets are we going for is the high-yield protocols first, and some lower yields stablecoin protocols. And with the highest protocols, it makes a lot of sense, because if there is a lot of yield to go around, it makes sense to de-risk the investment and still get a very good return on your investment. The future opportunity, we expect the whole space around securing risk in DeFi to grow as more players from TradFi are coming in. And similar market in TradFi, credit default swaps, it's not apples to apples comparison, but but it is also a similar kind of product protecting default swaps. Is $9 trillion market in TradFi. So now, how it's built, how does it work? The mechanism is quite simple. So we take some base yield. You can think of Pendle. You can think of other DeFi yields. In this example, it's 15%, and we split it into two. We have a protection buyer, and he sacrifices some portion of the yield and basically gets a token that is already DPEG protected, and in this example, he will get 12 instead of 15%. And the yield buyer, the same thing, but he's taking on more risk, so he needs to be paid for that, so he's getting 18%. Okay, oh, sorry for that. Just to go quickly through an example, if there is no DPEG, obviously the payouts are going to be the same as I've explained, 12 and 18%. If there is a DPEG, however, Bob will still get 12%, so not just the principal, but also basically the high watermark price that the asset got before the DPEG. And Sean is taking double the hit from the DPEG. So in this example, the DPEG is 5%, so he's taking 10% hit. Now, I've prepared some special slides here, more focused on the mechanism itself. So as you can imagine, the mechanism is we have some token, and we split it into two tokens. One is the yields boosted part, the other is the DPEG protected part, and you can think of tranching. So if there is any DPEG, it goes, the losses are paid out from the junior tranche, which is the yield boosted asset. Now, we have kind of a risk trilemma of different protocols that secure risk in crypto. You can pick 2 out of 3, but you can get around the third one a little bit. But basically, either you have some underwriter risk and yield preservation, or you have no underwriter and full coverage, or you have yield preservation and full coverage. So let me go to the next slide and see basically what risks are you undergoing, what are the trade-offs. So the protocol risks, all the risks of the underlying protocols are covered. Obviously, there is still a smart contract risk of the Tapir protocol itself, but basically you can think of stacked protocols as a pendle. So if you have a pendle token, there is a risk of pendle itself, there is a risk of the underlying token, and you can think of, you could have like more protocols stacked one under each other, and that's all covered. The resolution risk, it's fully automatic, it's fully on chain. There is no committee that decides anything. And loss coverage, this is up to 50%. And this is because we want to preserve capital efficiency. That's what we focus at. So basically, the tokens give you the claim on the underlying. If the underlying is worthless, your claim will be worthless. We kind of go around this by not leveraging, by auctioning out the collateral, but yeah, if this is the worst case scenario, if the collateral cannot be auctioned out in time, you can take some losses on even if you have the DPEG protected token. And this is how basically, for us, it makes sense because in this way, we can ensure full capital efficiency. Okay, this is perhaps for the questions, more about how it works in depth. And I wanted to say a few more words on the yields. So we take success fee and withdrawal.
Okay, judges, you have to pick one star team. Ask the questions.
Can you describe the yields a little bit more? Can you describe the yields a little bit more?
Yeah, so the yields, how protocol is making yields. So there's a success fee. Basically, the yield protocols are making some yield. We take 5%. I mean, not we, the protocol takes 5% from the yield that is generated and 0.5% withdrawal fee. And then basically how that is translated to the Tapir token price, there is automatic buyback and burn mechanism that automatically buys back the Tapir tokens with 50% basically of the revenue gained. It will buy back the token and burn it. So very direct value transfer.
How exactly does the liquidation mechanism work and settlement if underlying assets are down 50% or more?
Yeah, so how that would work, we have some kind of a threshold that if it's hit, for example, if the asset's DPEG under 80%, we'll start, not will start, but we'll auction off the collateral of the underlying. So there is some threshold. If it's hit, we'll basically run the auction.
What's the typical depth for DPEGs? Like, does it typically get to 50%? Is there an arbitrary limit there, or could you change that number? Like, how deep do DPEGs?
We are also conscious of this, that this is potentially problematic, so we would not onboard like just any type of collateral that is completely wacky, like algo stables and stuff like that. With most things, it makes sense because with staking protocols or regular stablecoins, even if there is some kind of a problem, if there usually you wouldn't expect larger than 50% DPEG. Obviously, it can happen, as we have seen with XUSD, but it would not pass like our screening in the first place.
Makes sense.
That's it?
Yep, all set.
Okay. Everyone, that was Marko and Tapir protocol. Give it up for him. Thank you, Marko. Next up, we have Illia from LTV protocol. Illia, 6 minutes.
Thanks.
Go.
Hey everybody, my name is Illia. I'm a CEO and co-founder of the LTV protocol, and what the LTV protocol is. So we are building the first ever fully curatorless leverage tokenized vaults that anybody can deploy on top of any pair of tokens, on top of any leverage source. And I'm also proud to say that the first vault, our pilot vault, was deployed like literally a week ago. It's the Lido over Ethereum X12 leverage on our V3. We already have more than 12 million in leverage TVL. The current strategy rewards is like a little bit more than 8% of the APY on Ethereum, and plus our incentives. And even with 7 days in mainnet, we already top 65 borrower on the Aave. Now, a bit about how it works. So when I say curatorless leverage vaults, we need to, I mean that there is no curator involved in managing the leverage position. To manage the leverage position, we basically need to always keep some target LTV, some target leverage. And this equation is basically our target LTV equation that is similar to the Uniswap constant product formula, keeps in the heart of our mass model, which is basically described in our paper that we published a year ago. When I say we, I mean this beautiful team of Mass Olympic winners, ex-Aave engineers, our CTO is ex-Matter Labs, the guy behind the ZK Sync. And on the security part, we are partnered up with the Oxoria, who basically audited both Aave and Lido. And we finished the security audit like 2 or 3 weeks ago without any critical issues, only one major, which is already resolved. So now that we have like the code to deploy these permissionless leverage vaults, where these vaults will come from? To answer this question, we did like a big research on the market opportunities across the 7 different chains. We analyzed possible leverage vaults for the yield strategies. And the 2 big numbers coming from this research is that there are more than 130 vaults that are possible to deploy with more than 18 billions in possible liquidity for these vaults. So as we see, like the market is pretty big. How we get the users on this market? One part of the question is that as a part of our go-to-market strategy, we launched the utility NFT, the 42 NFT campaign, which we allocate to our early supporters. There are more than 200 NFTs is already minted, like the average balance of the holder more than 100K. And this NFT is basically we use it to get the early access for our users to our new vaults and to give them the 42% point boost. And I also want to share a bit about the LTV token and how we can, with LTV token, how we can help our users to assess the risks of the leverage vaults more precisely. So our token is supposed to be staked into specific vaults. By staking it, the stakers will get some part of the fees generated by the vault. By the way, we generate 20% performance fee and some auction fee additional. But these stakers, they basically can be slashed in case of the malicious action of the third party. So in case the lending protocol behaves in some malicious way, or the oracle, the stakers can be slashed. And by doing this, we are basically create this native market-based like risk scoring system. And also we create direct correlation between the vault's TVL and the token market cap. And yeah, right now, as we already on the mainnet, we are raising a seed round, 1.5 million. And also like we are great to discuss the possible LP deals, both for the next vaults and for already deployed. It looks like I'm 2 minutes earlier, so that will be more times for the questions.
Fantastic. I like that you made a very specific ask. Questions, comments, feedback, judges?
Can you share a little bit more about how auctions are protected from MEV?
So basically, it's like a Dutch auction, which is so we create some pool of the incentives, which will be put into the price of the auction, to the exchange price, to incentivize like the auction executor, right? And we like unlock this incentives gradually with the block time, with like different setups for different vaults, obviously. But yeah, so yeah, it's open auction. Anybody can execute it, and yeah, just the price is going up from block to block. So everybody has the incentive to go first, and yeah. No MEV bot can like jump and sandwich this additional reward because it's unlocked just from block to block.
How would you differentiate your leverage vault offering from existing offerings in the market, like we learn the leverage vault sort of earn section?
Sure. So that's why I said curator so many times. All the existing solutions to give you a leverage position, they are basically either like require some manual creation for each user when you decide like how much leverage do you want to have, like when to rebalance the position, etc. Or they have like the creator or the admin manager or like the backend, whatever, which is like centralizedly from somewhere off chain decides how to execute the strategy. What the strategy will be, like can decide to, I don't know, rebalance from 10x to 1x at some point. In our case, we don't have anything like this at all. So like the system is fully on the smart contracts.
Are you going to expand beyond Aave to Morpho or other platforms? And if not, why?
It's just like the pilot vault, so we decided to go with Aave as it is the biggest liquidity pool. We already have like the connectors to both to Aave and Morpho, and we are planning to expand it like in the nearest time. So yeah, we're planning to cover like as much EVM chains as possible, as much like possible lending connectors, yeah. And it will be pretty quick because the architecture is modular, so we just like plug in the new connector and
Illia, do you want to ask anything to the judges?
Does anybody interested in making LP deal?
Happy to talk about it after the presentation.
Sounds great.
I have a follow-up question. I'm sure you're familiar with protocols like Treehouse that create these leverage looping strategies and tokenize them so that you can enter these leverage loop positions in the form of a sort of leverage loop token. I guess who would you define as kind of the closest competitor of yours on the market today?
So, like, I think almost all of platforms you mentioned is like kind of competitors to us. I think in terms of like first vault, we can define the Instadap Lite V2 vault for Ethereum, but like, again, this is all vaults that are curated. So in that way, we're not thinking about them as like direct competitors because they are basically providing the curated DeFi strategies overall, and they can switch to different strategies over the time. What we are doing, we are providing this like new kind of primitive, like the permissionless leverage token. But yeah, you're right that right now, some of them doing like kind of a similar strategy, but with the curation. Yeah.
Thank you. And then one last follow-up question, and that is...
Essie, we are on time. I'm sorry. Yeah.
No worries.
Thank you, Illia. Okay. Good job. Can we give it up for LTV Protocol, guys? We also gave Illia 1 extra minute to talk to the judges because he was 1 minute before for the pitch. So founders, if you're going to keep your pitch short, we might give you extra time to talk to the judges. Okay. Next one is Johannes from Frankencoin.
Hello, everyone. Thank you so much.
6 minutes, go.
Hello, yeah, I'm Johannes, and I'm going to talk to you about some really cool stuff. Do you know that 99.8% of the stablecoin market cap is currently in US dollars? It's no bueno. This chart you see here is the last 50 years or so of the dollar against the Swiss franc. Yeah, the dollar is not a really stable currency, is it? And that's why we need a Swiss franc stablecoin, and that's really what we built. There's lots of research kind of supporting that as well. You know, there was, for example, this French university, it was beginning of this year, and they were looking into Bitcoin. Bitcoin as a safe haven against geopolitical risk. And what they found out is, oh yeah, Bitcoin is a very good hedge, but so is the Swiss franc. And that's why we built Frankencoin. And you know, what is Frankencoin? Frankencoin is a fully decentralized Swiss franc stablecoin, and there's a bunch of really interesting attributes on why it is built this way, and I'm going to share those with you today. And also that has a bunch of cool attributes and functions, what you can do with that. Now, on a very basic level, the Frankencoin is a CDP, right? It's a CDP, it's a borrowing platform. You provide some collateral, and you borrow Swiss franc or CCHF in turn. Now, the CDPs have one big problem, and that is capital efficiency. You need over-collateralization. However, the Swiss franc is a bit of a special case, and I actually have a book about that, and there's a lot of things happening in here. I will give it to someone in the audience at the end, so I'll put it here for now. But basically, Switzerland has a combination of two very specific environments. One, how does Tether make money? How does Circle make money, right? You issue a stable coin and you get the risk-free yield in between. That is a super lucrative business model. In Switzerland, we have negative interest rates. Doesn't work. You can't really do a business. At the same time, the regulator in Switzerland has decided last year that if you accept money from someone and this someone has a claim on that money, you're a bank. Need a bank license. Okay, you know, if you're a stablecoin issuer and you're the size of Tether or Circle, you can get a bank license. It's expensive, but it's possible. They also said that anyone who has that claim against you is your client, needs to be KYC'd, AML'd, and onboarded as a client. And that, in fact, led to what we're seeing right now, the fact that you cannot transfer those stablecoins anymore. And there were a bunch of Swiss franc stablecoins, you know, the DCHF, the XCHF by Bitcoin Swiss. They basically all died because of this regulation. So this puts Frankencoin in this very special environment where the only real way you can do a Swiss franc stablecoin is in the decentralized form. That's only one part of it. The second part is how Frankencoin is built. I mean, if you look at CDPs, most of them they travel back historic, you know, towards MakerDAO. That is the great grandfather of many of those protocols. You have liquidity, which is a kind of a different approach. Frankencoin is inspired by liquidity. Thank you so much. I think there's some liquidity people here. Thanks a lot for that. But it has one extremely big property. It is oracle-less. You don't need an external price oracle to be able to have a collateral. Now, how this works is it has a built-in price finding mechanism. It has a built-in capital formation mechanism, and it is slow instead of fast. We don't have time to go more in depth here, but what this basically means is that you can now use collaterals which have no current deep liquid markets as collaterals. They only need to be eventually liquid because of this capital formation process. And this opens up the universe of collaterals you can use tremendously. For example, I have two examples here. You know, you have the B and the Q. Those are both Swiss tokenized or companies which have their equity issued as tokens. Now, why is this interesting? If you look at a CDP, CDPs are per se very secure instruments. They're very stable. They have one big problem, though, apart from their capital efficiency. That is, if you have huge correlations in the market, if you have crashes with correlations, so you need to have buffers. Now, how do you solve that? You solve it by having uncorrelated assets. Crypto assets tend to be correlated. And by being able to introduce like smaller uncorrelated assets, such as stocks or RWAs natively, which currently don't have deep liquid markets, you know where I'm going? That makes the whole system a lot more secure. So to sum this up, you know, Frankencoin is a decentralized Swiss franc stablecoin. It is fully live since the end of 2023. It's the largest Swiss franc stablecoin, but it's also one of the largest non-USD, non-Euro stablecoins. It's actually the second largest non-USD, non-Euro stablecoin currently out there with 29 million TVL. It is Oracle-free, allows you to have a wide universe of economically viable collaterals. And, you know, I didn't go into that very deep now. It is managed, again, fully trustlessly, completely decentralized with the so-called FPS, the Frankencoin pool share, which is a governance token that also has participates directly in the system profit and losses. So you as investors, you can, you know, have two ways to participate. You can, or three ways actually. You can hold Swiss francs, which, you know, you have 8 seconds. You have the FPS and you have the LPing. Thank you.
Three minutes, judges.
Nice work. Curious, most CDP-based stablecoins are byproducts of the demand for leverage where users will loop several times in order to get more exposure. What is the advantage for users depositing into Frankencoin? I think the Swiss franc value prop is very appealing. Mm-hmm. What is on the other side for those users?
I mean, it's a very good point, right? It can be two sides. It can be either you want to have, and this is what we're seeing right now a lot, you want to have your debts in Swiss francs. Might be because you need your spending in Swiss francs, right? You want to pay your taxes in Swiss francs. And that is a pretty large market. It's one side. And the other one is really the ability to have a wider universe of collaterals. And just by having this, right, that is something which you will not find anywhere else in the market.
Thank you.
How do you ensure the peg?
How do you ensure the peg? Short term or long term? I mean, short term, it's market making, it's market forces, right? There's a bunch of incentives allowing that. Long term, it's a CDP. Downwards, I mean, I'm going very quick. Downwards is traditionally you have an arbitrage opportunity if it's a deep peg towards the downside. On the upside, we have bridges, which allows you to also arbitrage when you have a deep peg towards the upside.
I fully agree with you that Swiss franc is one of the best, if not the best, fiat currency to hold. So I think I would say it makes a lot of sense for people to hold it, but still, like, what would be your plan to increase the market cap here, and why doesn't this exist already?
I mean, it exists, right? As you see, it exists. I think it's a function of time, right? It's this when you look at holding it, risk profile is Lindy and size is what all people are looking at. Like, how long does a project exist? What is your market cap? Now, many stablecoin projects fake this one side by basically paying LPs to just blow up the market value, and that is we see a very value extractive kind of approach. We don't do that. So all the growth we see here is organic. I mean, we are picking up quite a bit. We just launched 2 months ago with Gnosis, the integration with Gnosis Pay, and the ability to kind of hold your Swiss francs and get a yield on it, and then kind of spend with your Visa card. And that had shown us a massive pickup in volumes. So it's use cases. It's there. It's just a function of time and Lindy, really. I think we have one more question. Time, if I'm very quick.
You've been live since 2023. Like, what's changing now that you're going to get more traction?
It's been a bit of a test project for like I joined. It was been done as a PhD thesis. I joined beginning of this year.
Okay, impressive. Great job.
What's the book? I gave it to Marko. Very good. Thanks.
I was about to say that he was carrying Costa's book around. Good job. Okay. Next up, we have Baraa from Stormbit. Baraa, 6 minutes. Go.
Hi. Hello, everyone. I'm Baraa. Today I'm presenting Stormbit, which is we're building a borrowing and lending protocol without liquidations. So without price path dependent liquidations. Oh, sorry. So yeah, the idea of Stormbit is to build a fixed term lending protocol where borrowers can borrow without liquidation during the whole duration of the loan. The problem we're trying to solve is that currently most DeFi borrowing and lending protocols like Aave, they want and they need to stay solvent all the time. So they rely on liquidations. And we know that crypto is very volatile, especially on the downside. So when price moves down, protocols start liquidate, and we get the liquidation cascades, and sometimes you get caught on liquidation cascade because you're not on the laptop and you cannot top up your collateral and end up getting liquidated at a very bad price. And we want to kind of address this problem. So what we want to do is actually, like I said, build a protocol where we match lenders and borrowers, and the terms are such as there is the borrowers cannot be liquidated during the term of the loan. So, and there can only be liquidated after the loan is finished. So we will have predictable liquidations after the loan is finished and avoid cascades. And what we want to do is actually to shift the risk, to transfer the risk from the protocol level to the lenders. So it's up to the lenders to manage their risk when they lend money to borrowers. one use case can think of is like recently we had the mega ETH sale, and suppose you want to participate and bid, and you had like 100K in USDC cash and 30 ETH, and the price at that time of ETH was around 4K. So it's equivalent to 120K. And you wanted to maximize your fill, so you wanted to bid the max amount, which was around 186K. So what you could do, for example, is that you go to Aave, and you put your 30 ETH and you borrow 86K against it. But the way the loan works on Aave is that I think the LTV of ETH is around 80%. So max borrowable amount will be 96K, and you will have a liquidation price of ETH for around 3,583. And unfortunately, what happened is that just after the mega ETH sale, effectively the ETH price dropped to 3,300 and then rebounded. And if you went that way, you would have been liquidated. But if you go with Stormbit, what we offer you is that you can borrow the 86K during a fixed duration, and we promise you that you're not gonna get liquidated during the duration of the loan. The way it works is that we have lending managers which create lending terms, the duration of the terms, the API they're charging, the collateral they're accepting, and the strike price. So effectively, issuing a loan here is like issuing a short put option. So the lenders are they're basically selling options to the borrowers. And why that would work? Why we think it will work? Because on the borrower side, they will happy to pay a premium for the no liquidation features, especially for a short period of time. I think they would be happy to pay a premium over the borrowing API on other protocols, just to be sure for no liquidation. While the lenders will be happy to take that risk and manage it actively. Think about it like when you go and rent a car. So you do pay, sometimes you pay insurance for the rental company, but since you rent the car only for a short duration, like the notional amount you pay in USD is not that much, but for the insurance company, since they issue insurance for a lot of customers, it makes sense for them to take that risk and manage it. How can lenders manage risks? It's a spectrum. For example, they can just decide to not manage the risk at all. Just be happy with the buying. If the collateral drop to the strike price, they will just be happy to buy that collateral. So you can think about it as placing a limit buy orders for the collateral, while their stablecoins are earning yield, not just idle on the centralized exchange. And on the other end of spectrum is basically each time they issue a loan, they buy a put option, and they're perfectly hedged. And they make money as long as the difference between the yield and the premium is positive. Yeah.
Okay, thank you. Judges?
Your slide said that borrowers will be happy to pay a premium for no liquidation risk. Can you give some details about what that premium is? Is it 2%, 3%? What is?
Okay. Well, suppose that the loan is for 2 weeks. You can actually perfectly price the loan looking at the price of put options on the option market, and for example, if you take 100K loan, I think for 2 weeks you pay in $2 or $250 is fine. And if you annualize it in APY, it's gonna be attractive for lenders, and borrowers will pay premium. It's like when you go, like I said, when you go to rent a car and you pay insurance for the car rental. The insurance in notional dollar is not expensive, but if actually you do the math and you look at probabilities, you'd see that you're paying a hefty premium. So that's the idea. Also, I think the same idea with Airbnb is that if you rent Airbnb for just 3 days, and you rent Airbnb for a month, the price per night that you pay for 3 days is higher than the price you pay for a month. So I guess for shorter terms, I'll say that for shorter terms, borrowers will be okay paying that premium because in notional dollar value, it's not that much.
One minute. Baraa, do you want to ask the judges anything? Judges, do you want to ask anything?
Yeah, we're running an audit for the smart contract, and we're going to be live soon. So if you want to join our liquidity program, you can scan the QR code. Happy to take other questions.
What was your motivation for starting this?
Sorry?
There's a lot of things you could do. Why did you want to start this? What's your motivation?
Okay, so the motivation of our co-founder is that actually at the end he wants to be able to issue non-collateralized loans because he saw that in countries like his, people actually issue non-collateralized loans, for example, for microcredit, etc. And the way to do it, that's planned for the future. But for now, we saw that I myself wanted to do the mega ETH sale, and I had some extra ETH. So to borrow against it, I had to go to Aave, but then I was looking all the time at the ETH price. What's my liquidation price, etc., etc. So thinking it's like you can pay for insurance so that you're not liquidated.
Thank you. That's it. Yeah. That was the Stormbit team, guys. Well, I wanted this to be like a real Shark Tank where, our judges could immediately tell us out of the 8 teams which one was their favorite, but unfortunately, that is not how it's going to happen here. Our judges will take time to review all the teams who pitched today and showed us their products. And then we will let everybody know who the star team is and who won this pitch competition on our handles. That is Stable Summit @StableSummit @Stable Summit. We'll announce the person who won the pitch competition soon enough on the handle. And I thank all my judges for listening to the product. I'm really excited to hear who the winning team is going to be. Also, judges might reach out to the team or anybody that they liked out of all our founders and express an intent to LP or invest in them. So founders also please keep an eye out for the messages. That's it for tonight. Thank you so much, judges, for taking the time for this. We have a dinner after this with all our speakers and sponsors. At the end, I want to thank Party Action people, Zach and Parveen, for putting this together. I'm really glad. I'm really glad I got to be a really small part of this team and organization. Thank you. But thank you, Party Action people. Thank you to all our stage managers also who've worked so hard to put all of this together. I thought it was just the Germans who were very prompt about time. And when the first time my mic was cut off in the middle of an announcement, I was like, okay. This is how it's going to work. Also, all our speakers and you guys, most importantly, who have stayed till the end. What, my time is up now? Oh my God, no. Can I take 2 minutes? Okay, thank you. So I just wanted to say thank you to all of you who stayed till the end and made this possible. This was the first time we hosted a conference like this outside of the small ones that Party Action people do. So it really means the world to us that you guys showed up and showed so much support and love. And on behalf of everybody and the organizing team, we are really grateful and we love you guys. everyone, this was Stable Summit, and I was your host, Mia. Thank you so much. Have a good rest of your evening.